So 2018, we believe, was a year of achievement across a broad front for the Nedbank Group. We seamlessly concluded the Old Mutual managed separation, one of the largest corporate finance transactions ever undertaken in South Africa, while at the same time producing a resilient financial performance, with our headline earnings up 14.5% in a difficult economic environment. And this increase in headline earnings was primarily driven by the ongoing turnaround in our investment in ETI off a low base. Non-interest revenue growth in particular was strong, as we benefited from good trading and investment banking activity, as well as good transactional banking income generation. Our cost-to-income ratio improved during the course of the year, meaning that we delivered positive jaws or operating leverage. Our return on equity, excluding goodwill, increased to 17.9%, driven by improvements on return on assets, and you'll see that the overall gearing levels of the bank remained relatively constant year on year. As a result of our strong performance and capital and liquidity positions, dividends for the year were up just over 10%. On the strategic front, our primary focus is on client experiences enabled by technology and people. We saw very pleasing growth in main banked customers in retail and improvements in market share in retail, business banking, and CIB. Importantly, our managed evolution technology strategy and digital fast lane programs are progressing well. And given their particular importance to our competitive positioning in the period ahead, I'm going to spend more time on these in my closing remarks. We continued to deliver on our regulatory change program, encompassing inter alia, anti-money laundering, IFRS 9, risk data aggregation, market conduct, and Basel reforms. And pleasingly, under this measure of transformation, we have now achieved level 1 status under the new amended FSC codes for the first time. Turning now to the economic environment. As we all know, economic growth in South Africa has been slow to recover post the December political developments, as increasingly the damage done to our economy and many of its key institutions over the last few years has become more apparent. The global growth environment was broadly supportive in 2018, but escalating trade disputes and geopolitical tensions have more recently resulted in a slowdown in global growth that will spill over into 2019. The South African economy started 2018 on a weak note, falling into technical recession in the first half, but has recovered to some extent in the second half of the year off a low base, and as we saw this morning, finished the year at 0.8% GDP growth. Policy uncertainty does remain top of mind, and while we have seen some progress, here the mining charter and some developments around tourism are positive, other key issues in our economy remain unresolved. Changes at key state-owned enterprises are certainly progressing well on the governance front, but there's a lot of much harder work ahead to resolve strategic, operational, and funding challenges, particularly at Eskom, which in the context of the South African economy we all know is a monopoly that is too big to fail. The announcements made to separate Eskom into generation, transmission, and distribution, as well as government's contribution commitment to an extra 23 billion rand per annum, are initial positive steps to resolve this crisis. But given the scale and complexity of the challenge, we should realistically expect a multi-year turnaround process at Eskom. While the major credit rating agencies have kept their outlook on the SA sovereign as stable, Moody's is the only one that still has maintained its investment grade. Our view is that the February budget has done enough to avoid a full downgrade at their next review by Moody's in March, although there is a risk that they may choose to change their outlook to negative, as the pressures on an already stretched fiscus from state-owned enterprises have caused uncomfortable increases in debt to GDP levels at the same time as economic growth is low and slow. Many of you may have seen this slide before, highlighting our very simplistic view of the stages of the South African turnaround story. The reality is we are still at the early stages of a political and institutional turnaround. Listening to the Nugent, Zondo, and other commissions are a difficult but necessary part of this to restore trust and the rule of law that is an absolute foundation to any progress. If we're successful in navigating the stages on the left-hand side, this should lead to more meaningful progress on structural reform and policy certainty, which in turn leads to higher levels of business and consumer confidence, higher levels of local and foreign investment, increased GDP growth, and then finally, as an outcome, reduced unemployment, poverty, and inequality. Our current reality on the left-hand slide, or Rama reality as the Financial Times recently called it, is that we are still in the orange part of the process. And in particular, until we have more certainty around Eskom, clarity on Section 25 and other legislation regarding land expropriation, and the outcome of the general elections in May is known, it seems unrealistic to expect any material acceleration in confidence and investment, and therefore growth and jobs. Our focus on delivering value to shareholders is illustrated on this slide that, again, Nedbank investors should be very well familiar with. It's our view of the key financial drivers for value creation in a bank. On the left, our net asset value per share grew at just over 3%, as organic NAV growth of over 9% was offset by the impacts of IFRS Day 1 accounting changes, ETI converting to the NAFEX exchange rate, our current best estimate of the devaluation of the Zimbabwean currency, as well as the 2 billion rand odd lot offer that we concluded in December post the managed separation. In the center, our return on equity improved as ETI returned to profitability, and this supported a growth in economic profit, or the difference between ROE and cost of equity. That's the gray shaded area in the center of the graph. Given that ROE is calculated on a daily weighted basis, the odd lot offer has not materially benefited ROE in 2018, but our analysis shows that there should be an approximate 30 basis points of uplift to ROE in 2019. Our solid earnings and capital and liquidity positions enabled the declaration of a final dividend of 7.20 Rand per share, taking the full year dividend to 14.15 Rand, up over 10% on the prior period. 2018 was certainly a milestone year in the history of Nedbank as we completed the Old Mutual managed separation on the 15th of October. 43 billion rand of Nedbank shares were unbundled to Old Mutual Limited shareholders, while at the time some investors had concerns around the potential of an overhang. Our share price being up 7% in 2018, that was the fourth best performing on the JSE Top 40 and the best of the South African banks, demonstrates that this overhang was not a material issue. After the unbundling, our share register had over 400,000 shareholders that held less than 100 shares in Nedbank. And as a result, we implemented an odd lot offer that we finalized in December. We bought back and cancelled 7 million shares at a cost of just under 2 billion rand, with an impact on our capital or CET1 ratio of 34 basis points. But this transaction will be both ROE and HEPS accretive in 2019. The outcome on our shareholder base is shown on the right-hand side. The benefit to shareholders include a significantly enlarged free float, and almost doubling in the daily average number of Nedbank shares traded. Our index holdings and foreign emerging market shareholdings have also increased meaningfully. Importantly, we continue to work with our sister company, Old Mutual Limited, within the framework of our new relationship agreement to deliver on the arm's length synergy benefits that underpin our ongoing and valuable relationship. Now that managed separation is behind us, we can note that, as we consistently said, it has had no impact on our staff, our clients, our operations, or our strategy. Finally, from me, a slide on the very important role that Nedbank plays in society and delivering holistically to all the stakeholder groups, evidenced in our purpose statement of using our financial expertise to do good. In the South African environment, This view of purpose and sustainability is absolutely vital as the social license to operate and be sustainably successful over time. There's lots of important data on this slide, so I'm just going to highlight a couple of key aspects. Starting in the top left, on the staff front, we continue to invest in our staff, and we've seen an increase in training spend as we prepare our business for increasing digitization. We've moved in our development environment from traditional waterfall development to agile squads and tribes aligned behind client journeys. And our workforce continues to transform to better reflect the demographics of our country, with nearly 80% of our employees now black. On the client front, we remained firmly open for business, with 181 billion rand of new loan payouts during the year. That was up 18% on the prior period, as we continued to support our customers and grow our customer base, in particular in more digital and self-service ways, as illustrated by some of the innovations on this slide. Pleasingly, we saw main bank client numbers grow across all our businesses. And together with the South African Reserve Bank, we helped over 17,000 VBS depositors access the money that was frozen that they needed to live. We continue to interact positively with shareholders, as evidenced by over 400 meetings that we held last year, our AGM voting outcomes, and we have ongoing engagements with regulators. We remain focused on serving and supporting the communities in which we operate, including supporting local business, with nearly 80% of all our procurement being done locally. We're playing an ongoing role in the CEO initiative and the ratings workstream in particular, and we have had some initial success on delivery of the Sustainable Development Goals. 2019 will see Nedbank participate in the Youth Employment Service, which will see us creating job opportunities for around 3,000 young South Africans, both within and outside of Nedbank. As I highlighted on the opening slide, we are now level 1 contributor as measured under the FSC codes, having been a level 2 contributor for the previous 10 years, highlighting the importance to Nedbank of ongoing transformation in a transforming society. I'll now hand over to Rasibi to take you through the detail and key drivers of our results.
Apologies for that interruption. Thank you, Mike, and good afternoon, ladies and gentlemen. I'm pleased to report that Nedbank produced a resilient financial performance during 2018. As we noted in prior periods, two lenses are provided to provide better comprehension of the key drivers of our results. As our results, including ETI in the first column, reflect a very strong increase in headline earnings, with a resultant increase in diluted headline earnings per share of 14% and an ROE improving by more than 1.5%. The difficult economic environment led to our managed operations, shown on the right, growing at a lower rate. Pleasingly, for both group and managed operations, the pre-provisioning operating profit growth was positive, and economic profit increased by 69% to 2.9 billion rands, with cost of equity broadly flat. We are pleased with the improvement in our net interest margin, our credit loss ratio remaining below the through-the-cycle target range, and a reduction in our efficiency ratio. These were in line with the guidance we provided at the interims, and I will unpack them in more details later. Our CET1 ratio, above the midpoint of our target range, supported our 10% dividend growth, as already covered by Mike. This waterfall graph shows that from a revenue perspective, NII growth was muted, and whilst NIR and associate income contributions were strong, impairments started to trend up and cost growth slightly higher than we expected, as the post-retirement medical aid credit did not materialize in the second half, as was previously expected. Ongoing efficiencies remain a key focus in our business. And as indicated previously, all costs relating to ETI are allocated to managed operations, as was the case in prior periods. Dividing the year into halves, on the far right, you can see that we improved our performance for managed operations in the second half of the year, while the turnaround in ETI annualized. Pleasingly, on the left, both NII and NIR accelerated in the second half of the year. Impairments showed slightly slower growth in the second half, but expenses increased as our systems commissionings had accelerated. Incentives also grew stronger in the second half, in line with our financial performance. As we reported in the first half, the IFRS 9 and IFRS 15 changes have had an impact on the shape of our income statement, and for this year, all of this are indicated on my slide. However, this forms a base for 2019. The columns on the far right of each graph show the like-for-like underlying performance when excluding the IFRS changes. We believe this is a more representative reflection of our performance. The graphs highlight stronger than reported underlying revenue growth, partially offset by higher impairments and expenses growth. Headline earnings in managed operations would have increased close to 5% on a like-for-like basis. On net interest margin, we saw an increase as we guided during our interims, and the key drivers include negative endowment following interest rate cuts in July 2017 and March 2018 respectively, before the upward cycle that commenced in November 2018. Asset pricing and mix benefited us 4 basis points as RBB grew advances faster than CIB, and we also benefited from improved pricing both in card and MFC. Our average interest earning banking assets increased 3.6%, accelerating from 0.8% in the first half. Turning to the new loan payouts, we have seen green shoots in most of our businesses, and I illustrate a few of this on my slide. Our credit application volumes in retail product lines have increased strongly in double digits, both in vehicle finance and in home loans. And our payouts are also strong in all of personal loans, vehicle finance, and home loans, indicative of a stronger book growth ahead. Personal loans applications were flat. However, payouts increased due to our loan tenures expanded to include 6 months and 72 months respectively, mainly focusing on our qualifying low-risk clients. In our wholesale portfolios, loan payouts increased both in business banking and in CIB. Our banking advances grew at 5%, and the acceleration started in the second half. This is evident on the right-hand side slide, where we reflect that the growth was underpinned by ongoing momentum in RBB and a solid growth in CIB in H2. From a product lens, commercial property growth was muted as competition increased, and we remained selective in our origination. The CIB banking advances growth in the prior year is evident in the stronger growth in term loans. The loss of market share occurred largely in the first half and was impacted by lower client demand in commercial property and higher volumes of settlements in core corporate loans, again mainly in the first half. In our retail business, growth was solid across all products. Deposits grew 7% ahead of advances, improving the group's loan-to-deposit ratio to 89%. Through increased focus in RBB, deposits grew 9.2%, supported by products such as retail bond deposits. The slight loss of market share in household deposits was disappointing. However, it remains a key focus given its importance in a Basel III environment. For our corporate clients, deposit growth was 5% and was supported by increased appetite for NCDs as clients shifted from structured products. The NCDs are managed in central management in line with our ALCO risk management processes. Coming to NIR, our non-interest revenue grew 8%, reflecting a resilient underlying performance, which was offset by the aforementioned IFRS changes. Excluding IFRS, the NIR growth was more than 10%. On the left, our growth in NIR was underpinned by growth across the key categories. Representing a higher proportion of NIR, our commission and fees grew 6.5%, driven by solid main bank client growth. Trading income had a strong growth, notwithstanding muted activity levels. Insurance income benefited from non-repeat of large weather-related claims which occurred in 2017. From a cluster lens, NIR growth in CIB was very strong, supported by commission and fees and trading income. Round 4 of the renewable energy transactions that closed in the second half of the year was one of the key drivers. In RBB, our growth was 2.3%, despite a 580 million rands base erosion from the IFRS changes. On a like-for-like basis, that NIR growth would have been 7%. The underlying growth reflects the momentum across the entry-level, middle market, professional, as well as the SME client segments. This provides some evidence of a strategy to grow our transactional banking franchise. In wealth, insurance income recovered from 2017, partly supported by lower claims, as I stated earlier. And in rest of Africa, we grew NIR, reflecting the benefits of investments in our core banking system and the rollout of several new products. Turning to credit loss ratio, the graph on the left provides an overview of the credit loss ratio increasing from 49 to 53 basis points, driven by the mix change as RBB grew faster than CIB. This was partly offset by lower credit loss ratio in CIB and rest of Africa, as these clusters recorded impairment recoveries. Over the 12 months, defaulted advances increased by 29% to 25 billion rands, and this represents an NPL ratio of 3.3%. The increase occurred largely in the first half in CIB, primarily as a result of stresses in the construction and cement industries, reflected by an increase of 74%. Further details of this will be provided by my colleague, Brian Kennedy. In the second half, the increase of 1.9 billion rands was as a result of changes in our point of write-off, which was changed to align more closely with industry practice. We had advised in our interim results that this IFRS 9 requirement remained under consideration, and we only implemented it in the second half. Reflecting on the graph on the right, prudent coverage levels were maintained against defaulted advances, with a specific coverage ratio at 37%, slightly down on the opening balance and the June number, as it was impacted by the change in the point of write-off. Stage 1 and 2 coverage reduced due to a combination of releases of overlays and migrations of portfolios to stage 3. We retained our central provision at 150 million rands, particularly in the context of a challenging South African environment, as well as current economic developments in Zimbabwe. Turning to expenses, we continue to focus on cost management in response to a difficult environment. All our frontline clusters managed their expenses well. We delivered positive jaws when including associate income, and excluding associate income, our jaws was flat. We remain committed to our cost-to-income ratio target of equal to or less than 53% by 2020, despite the downside risks which have crystallized across all our markets. On the right-hand side, we show what has changed since we set our target at the start of 2018. Revenue growth has been weaker than we anticipated, and interest rates follow a shallower profile, which will mean lower levels of endowment income. Whilst the lower endowment will also imply lower bad debts, such benefits do not impact the efficiency ratio. On the positive side, we continue to make good progress on primary client gains, which will continue to improve our revenue. On the expense side, IFRS changes introduced a run-rated 30 basis points negative impact on the efficiency ratio. We have also seen new costs that we need to absorb, and this would include the contribution to the Youth Employment Service that Mike spoke about earlier, and this starts in 2019, the Deposit Insurance Scheme and Twin Peaks costs, which we expect to be introduced and kickstart in 2020. In addition, we plan to make investments in platform activities to underpin our future growth. Putting all this together, we illustrate in the matrix the impact of various revenue and expense growth assumptions. If revenue growth disappoints, we will continue to increase our focus on lower cost growth to ensure that we maintain a downward trajectory towards our cost to income ratio. Good progress was made on our target operating model initiatives. We continue to optimize our branch footprint, cost efficiencies as clients adopt self-service banking, and we benefit from lower levels of design costs as we embrace agile development and digital fast lane. 680 million rands of cumulative savings have been unlocked to date on our way to the 1 billion rands and the 1.2 billion rands targets for 2019 and 2020 respectively. As reflected in our earlier slides, ETI has made a significant contribution to the group's growth in 2018 and has now recorded 7 quarters of positive profits. Mfundo will provide a further perspective, but we remain supportive of the long-term opportunities from this strategic investment in ETI. While our carrying value remained almost flat, the associate income I noted on the previous page and the FCTR changes were offset by 800 million for IFRS 9 on a fully phased basis and 400 million to adjust for changes in ETI's reporting currency in Nigeria following ETI board's decision to adopt NAFEX late last year. We monitor the valuation of this investment at each reporting period for inter alia indicators of impairment. Although our value in use is materially in excess of the carrying value, we do not consider it an appropriate timing to release our impairment taken on this asset in prior periods. Our CET1 remains well above the sub-regulatory requirement and above the midpoint of our board-approved ratio of a range between 10.5% and 12.5%. The movement in our CET1 ratio reduced as we absorbed the IFRS 9 day one impact for our own operations and ETI for a combined 21 basis points on a fully phased basis. The odd lot offer concluded in December 2018 reduced CET1 by a further 34 basis points. Capital generation was strong as earnings grew, but offset further by the payment of dividends and on the back of 11% RWA growth, which includes some rating migrations in our portfolios. Our capital position and organic capital generation has supported our ability to pay a dividend at a 51% payout ratio, and this is below the middle of our board-approved target range of 1.75 to 2.25 times. From an investment perspective, our dividend yield remains attractive for shareholders, especially in times of slow earnings growth. A brief overview of our performance in the clusters shows solid growth across all our clusters, with the rest of Africa a standout performer supported by both ETI turnaround and the subsidiaries. I will leave further details to be covered by my colleagues a little later. Coming to my last slide, I would like to just unpack some key movements in the center. 2017 was a particularly low base, benefiting from the 350 million rands release of central overlays and large fair value gains. In 2018, the credits in the center were mainly the post-retirement medical aid release of 250 million rands pre-tax, and it occurred in the first half. We currently expect a similar amount to be released in 2019. I thank you, and I will now hand over to Brian to cover CIB.
Thank you, Rasibi, and good afternoon to everybody. CIB's results reflect a good performance, with headline earnings increasing 6.3% to 6.7 billion, driven by excellent growth in NRR, which was up 19% in a slow growth economy. This strong NRR growth is reflective of our ability to create and execute client solutions, which strengthens the CIB franchise even further. Despite the uncertain economic environment, we have maintained a low credit loss ratio of 4 basis points as a result of proactive risk management. Our efficiency ratio improved slightly to 41.9%, as we have grown key focus areas by investing in talent as well as capitalizing on digital opportunities to ensure an improved client experience. Our ROE was maintained at 20%, indicating high quality earnings, although we did experience a slight deterioration due to rating migrations as clients experience pressure in this uncertain economic environment. Growing NRR has been a strategic focus area since the formation of CIB in 2015, and it is pleasing to note the upward trajectory with a CAGR of 12% over the past 4 years, as well as the 19% growth year on year, with good contributions from all of our business units. It is noteworthy that NRR has expanded from 5.4 billion to 8.5 billion over just 4 years. Our markets business showed good NRR growth, with trading revenue up 16% for the year. Debt securities, double-digit growth in FX trading, as well as equities all contributed. We continue to focus on growing our primary bank clients, and our ongoing success has contributed to the growth in transactional non-interest revenue for the year, which forms part of the fee and commissions line. The 30 new primary bank wins in 2018 will contribute to growing our transactional base. The 21% growth in fees and commissions was a result of higher arranging fees in debt finance and distribution in our investment banking business, essentially leading and concluding bigger transactions. We have also invested in growing talent across these businesses, so it's pleasing to see the NRR to expenses ratio increasing significantly year on year to 130%. The NRR to advances ratio has also improved significantly from 1.83% in 2014 to 2.41% in 2018. In the recent Dealmakers Awards, CIB was awarded the number 2 position in M&A Investment Advisors by Dealflow and the top BE Investment Advisor by Dealflow. We also placed first in the Bloomberg Fixed Income League Table rankings and achieved numerous awards for our dealing and research teams. CIB has continued to be a significant debt provider to corporate South Africa, although average banking advances were relatively flat year on year, as growth only accelerated in the latter part of the year. This is reflected in our actual banking advances, including corporate bonds, which grew 6% year on year, with most of the growth in investment banking as the teams closed significant transactions in the latter part of the year. In addition, our energy team closed 12 renewable energy projects under round 4 to the value of 13 billion, including solar PV, wind, and South Africa's first biomass project. Growth was more muted in property finance, although we have maintained our leading market share. The advances pipeline is solid, presenting a growth opportunity as business confidence improves. It was also pleasing to note that CIB was awarded the Project Finance and Local Currency Deal of the Year for their Nell and Gator mining deals. One of the positive features in this set of results is the low credit loss ratio of 4 basis points. This reflects the quality of our portfolio and our proactive risk management. Despite the competition in the market for high quality assets, we've maintained our margin at 2.12%. Defaulted advances increased from 2.9 billion to 5.7 billion as a result of active involvement with clients to restructure and resolve distressed assets. A material number of the restructured assets are performing according to plan, and we anticipate them moving back into the performing bucket in the second half of 2019. The major contributors to the 2.8 billion increase in defaulted advances was due to large counters in the construction and cement industry. The high level of collateralization for these defaulted deals has resulted in a decrease in the specific coverage ratio to 11.6%. The portfolio coverage ratio on the performing book decreased to 28 basis points due to the reclassification of a single counter to investment risk. This was offset by the migration of risk ratings for exposures within high-risk industries. In 2019, we will continue to monitor closely the stressed sectors of the economy, such as construction and cement, REITs with large office government exposure, and parts of the retail sector. Focus will also continue on certain SOEs as a result of the rising government debt burden and ongoing uncertainty in terms of SOEs' liquidity, although progress has been noted in the board and management changes of some of these counters. More information is included in the booklet slide. So in the last slide, turning to prospects, our key priority remains to better serve our clients through greater insights and solutions and to enhance revenue synergies across the business. Building on our past success, we will continue to expand NR growth, not only through transactional banking and trading, but also by expanding our advisory and private equity business. Our advances pipeline is strong, but will be impacted by the uncertainty and lower investor confidence ahead of the May elections. This will partly be balanced by the expected drawdown of transactions closed in the latter part of 2018. We will work with our strategic partners to increase our expansion in selected sectors on the African continent. We also seek to capitalize on our leading property positioning by expanding the property business into the rest of Africa. Our 2020 targets remain a ROE greater than 20% and a cost-to-income ratio of less than 40%. Thank you very much, and I'll now hand over to my colleague, Sika Thomas, to deal with RBB.
Thank you, Brian, and good afternoon, everyone. Retail and business banking earnings grew by 1.5%, with ROE at 18.9% in a very challenging economic environment. Headline earnings have been impacted by IFRS 9 and 15 changes, which were introduced in 2018. Raisibe alluded to these earlier. Adjusted for IFRS, earnings grew by 6.4%, in line with expectations in a difficult trading environment. NII grew by 5%, impacted by margin compression in the deposits business and lower levels of endowment. Advances and deposits reflected pleasing growth, with average advances growing by 6%, driven by market share gains, largely in MFC, and to some extent, green shoot market share gains in both home loans and personal loans. NII grew 7% on an IFRS-adjusted basis, driven largely by gains in retail main bank clients. We grew expenses at a judicious 4.7%. This growth level includes our investment in physical and digital distribution and was achieved through a rigorous and continuing focus on active management of expenses. The credit loss ratio across RBB is flat at 106 basis points. It continued to benefit from our quality book, from collection efforts, and a focus on resolutions. Retail banking NIR grew at over 7% in total on an IFRS-adjusted basis. Pleasingly, IFRS-adjusted growth in transactional NIR is up by 8.1% in this period. This growth in NIR is in spite of the moderate increases in pricing and has benefited from the 7% growth in overall main bank clients, testimony to our focus on continuing to drive deeper penetration of revenue-generating offerings offerings from each client relationship. We are pleased to continue seeing growth in our base of main bank clients. Main bank clients now constitute a shade under 3 million clients of our total client base of some 7.5 million, up by 6% on the previous year. In this slide, we unpacked this main banked client growth by client segment. Growth has been strong in our middle and ELB segments, coming through at 9 and 8% for both these key segments respectively. Our Mobi Money value proposition, launched late in 2018, should allow the ELB segment in particular to continue to grow strong. Most of the other client segments have also shown growth in this year, with only the youth segment showing some decline. The youth segment, of course, is vital to our growth aspirations. To this extent, therefore, we are confident that the recently introduced Unlocked.me value proposition aimed at the youth and young adult market will address this decline. In the current year, by way of illustration, all-week activities on university campuses have already seen encouraging new client acquisitions, with sales up 26% so far this year compared to a year ago. We have successfully launched several innovative products and solutions during the year, 3 of which we have highlighted proudly on this slide. Reading from left to right, these are our Stokvel proposition, an innovative new first-to-market product that aims to satisfy the real needs of the Stokvel community. It enhances the social saving solution by adding a best-in-market burial benefit of 15 rands per member per month and offers rewards on the account as well as financial education for Stokvel members. Second is Mobi Money, which we launched in August 2018. This platform allows clients to receive and send money, buy airtime and electricity from a cell phone, and withdraw money at a Nedbank ATM. All of this without a formal bank account and using nothing more than a feature phone and your USSD string. Thirdly, we launched the Unlock.me money account in December 2018. This student offering is a 0 monthly service fee account. It can easily be opened digitally on the Nedbank Money app within minutes. The account offers monthly rewards in the form of data, of food, transport, and entertainment. The offering also includes access to a jobs portal. The money account was launched on the back of the fast-growing youth lifestyle portal, Unlock.me, which we launched in 2018. Other innovations in 2018 worth mentioning are the Clever Frontline CRM tool. This tool is used for needs-based analysis in the front line. It is an AI-based digital tool designed to assist our staff in having comprehensive, consistent, and relevant conversations with our clients. Worth mentioning also is the schools app Carry, which has gained momentum with over 200 schools signed up and over 19,000 active users. Our refreshed loyalty and rewards program will also be launched later this year. As a result of all these innovations and ongoing focus on improving client service, Nedbank Retail has seen the largest increase in the Net Promoter Scores in the Consulta survey amongst all the retail banks in South Africa, increasing by a full 11% to 37% over 2018. We launched the Nedbank Money app in November 2017. The app has now reached 1.6 million downloads and more than 435,000 active users as at the end of December in 2018, in just over a full year. By the end of 2018, we have also added a total of 70 services on the app, at an average of over one new service a week since its launch. 28 of these services were added in the 16 weeks between August and November last year. Looking at the visual on the left of this slide, you will also notice that our Money app is rated at 4.5 on the Apple Store. This is the best rating of any retail banking app when compared to the competition. On the Apple Store, the other big 5 peers, including Capitec, enjoy an average rating of 2.95 amongst themselves. The only banking app that outscores us actually at 4.7 is Ilanda's world-leading app, but more of that from Ilanda herself later. There are 359 cost initiatives that are currently being tracked in retail and business banking and that are delivered through our Business Transformation Office against the 4 themes reflected on the left hand of this slide. Our focus on moving the size of customer activity out of branch is evidenced by the increase in the usage of our self-service devices, as well as a reduction of in-branch volumes in 2018. This allowed us to achieve a net headcount reduction once again through natural attrition. Good progress on the adoption of robotic process automation and the predicted traction and adoption of digital sales and service will allow us to further rationalize physical infrastructure. We closed 18 points of presence and opened 4 new branches and 5 in-retailer outlets, resulting in a net reduction of 9 physical points of presence. The reduction has not, however, affected our levels of coverage of the bankable population in South Africa. In this year, we have revised our targeted reduction in branch space to more than 45,000 square meters by the end of 2020. This slide re-emphasizes the commitment we made in 2017 to reduce our efficiency ratio to close to 58%. The last 2 bars reflect our cost efficiency initiatives and client growth aspirations, which are key to improving this ratio. The first 2 bars will, however, be impacted by the much tougher macro environment in which we're doing business, changes to IFRS, and our exciting investment in ecosystem-based platform propositions. These impacts will make it much harder to achieve this efficiency ratio target by 2020. In spite of these challenges, however, we remain committed to doing everything within our means to achieve our goal. A highlight of these numbers is again the delivery of good growth in business banking. These growth levels have been achieved despite the slow economic growth, which has seen lower levels of business confidence, with business owners delaying key investment decisions as they manage their cash flows more carefully. Notwithstanding the economy's vagaries, average advances in business banking grew by 8%, largely due to a 20% increase in new loan payouts, coupled with a 9% increase in drawdown on existing facilities by clients. Pleasingly also, we have achieved a 3.1 point improvement in market share in business banking to 21.6%, based on an external market share survey that we participate in. And finally, I'll move to prospects for 2019 and beyond. We remain committed to our client-centered growth strategy and on boldly executing on our plans to deliver delightful client experiences through digital transformation, using the 5 key strategic levers reflected on this slide. We continue to drive towards achieving our targets for 2020, which include an ROE of greater than 20% and a substantially lower cost-to-income ratio. Our focus remains on accelerating financial inclusivity of our banking propositions to meet evolving client needs through delivering competitively priced products, actively reducing transacting costs for our clients through digital banking services, and of course, tapping into ecosystem-based platform propositions that offer beyond banking solutions. Thank you very much, ladies and gentlemen, and I'm pleased to hand over to my colleague, Ayolanda.
Thank you for the lovely introduction, Tsiko, and good afternoon, everyone. Nedbank Wealth's headline earnings increased 6.1% to 1.1 billion rand above nominal GDP growth. ROE declined to 26.8% due to an increase in allocated capital as a result of balance sheet growth, while EP increased 2.7% to 536 million rand. Insurance and Wealth Management International delivered strong performance, while asset management remained relatively flat due to a subdued economic and market conditions, resulting in a decline in AUM. The challenging environment resulted in lower trading and overall business volumes impacting wealth management local. Taking a look at divisional performance, Wealth Management's headline earnings increased 3.3% to 295 million rand, mainly driven by strong international performance with a positive interest rate environment as well as underlying growth in banking and investment activity. Locally, performance was impacted by muted market conditions, resulting in reduced business activity as well as lower portfolio management and brokerage fee income. Overall, Wealth Management experienced marginal balance sheet growth, with liabilities up 2.6% and advances remaining flat. The Nedbank Private Wealth app was ranked second best mobile app globally by Qatar Associate International Research and supported by TICO. Turning to asset management, overall, the asset management industry has proved challenging with significant pullback in markets and investors opting for lower risk products, negatively impacting margins. Despite this, asset management headline earnings remained flat at 337 million rand. AUM decreased by 4.8% to 297 billion rand, with net outflows of 10.7 billion. The business continues to see strong growth in passive, international, and cash solutions. Nedgroup Investments was named Offshore Management Company of the Year for the fourth consecutive year at the 2019 Raging Bull Awards and was also recognized as Best Fund House Larger Fund Range at the 2019 Morningstar Fund Awards. Moving on to insurance. Insurance headline earnings increased 11.8% to 501 million rand, driven by growth in premiums and lower claims across life and non-life products. Life value of new business increased 8.9% to 380 million rand as a result of growth in credit life policy sales and average premiums. This was partially offset by higher lapses, mortality, and lower sales of single premium investments. Non-life gross written premiums grew 2.7% to 1.1 billion rand, mainly due to an increase in vehicle value-added product sales. Life embedded value increased to 2.8 billion rand, representing a 25% increase before dividends paid. Taking a look at developments to enhance client experience, we have continued our focus on leveraging innovative and digital enhancements to improve client experience. In wealth management, we continue to enhance the Nedbank Private Wealth app with great new features and functionalities and have recently added the Nedbank Private Wealth International offering to the app. Asset management introduced Extraordinary Life, an automated online investment portal, which is a new unique service solution driven by a user-friendly chatbot that personalizes and optimizes individuals' portfolios. Nedbank Insurance single policy administration system for life and non-life products, which went live in 2018, enables a single client view, improved client engagement, and faster processing of claims. Finally, turning to prospects, we anticipate a tougher 2019 locally with continued political uncertainty in the first half of the year. Internationally, the UK will continue to be impacted by the uncertainty relating to the outcome of Brexit. We will continue to focus on improving client experience through digital innovation and enhanced value propositions. A top priority remains providing long-term performance and driving market share across all of our offerings. We will continue to focus on collaboration efforts within the group. We are confident that we will achieve our 2020 ROE targets through stronger NIR growth. Our cost-to-income ratio, however, will be more challenging to achieve given the current and expected market environment, as well as our continuous investment in digital initiatives. It now gives me my pleasure to hand over to Mfundo.
Thank you, Ayanda. The rest of Africa business performed well in 2018 and delivered headline earnings of 702 million rand and returns lifted to 10.3%, reflecting a material turnaround from the loss of 810 million rand in 2017. This financial outcome is marked by more balanced earnings contribution from improving profitability of SADC subsidiaries and the turnaround in ETI. Our subsidiary businesses in SADC had a strong performance, achieving 98% growth in headline earnings from 165 million rand in 2017 to 327 million rand in 2018. Key growth drivers were good revenue growth with costs growing below inflation, improved delivery of digital solutions leading to more optimal client experiences, strong impairment recoveries in Zimbabwe, Malawi, and Lesotho that more than offset higher impairments in Mozambique and resulted in the credit loss ratio dropping from 102 basis points to 51 basis points. ETI recorded a material turnaround from a prior year loss of 975 million rand to headline earnings of 375 million rand. The key drivers of the turnaround included strong growth in client deposits, lower impairments and selective origination of new assets, as well as transactional revenue growth. In SADC, we completed key milestones in our investment for growth with the implementation of FlexTube in Zimbabwe and completion of mobile rollout in Malawi. Investments made over the last 4 years are helping us to transform the business to achieve faster growth. Positive growth has been registered across key financial drivers as follows. Average advances and average deposits grew by 9% and 8% respectively, underscoring balance sheet growth. Net interest income grew by 9% and net interest margins widened 13 basis points, reflecting the impact of better pricing and a continued tilt to grow Basel III-friendly retail deposits. Net interest revenue grew 21%, reflecting the positive effect of transactional account growth and origination fees from higher volumes of lending at a market-appropriate risk appetite. Lastly, stronger cost control contributed to a positive jaws ratio and helped improve our efficiency ratio by 230 basis points. Turning to non-financial drivers, client numbers grew by 5% with a focus on acquisition of quality clients and in doing more business with them. We reduced dormant accounts to acceptable levels. In the retail business, we experienced a higher retention of clients as our digitally enabled transactional solutions complemented our lending client value propositions. In line with transforming our business for the digital age, we registered 44% growth in app transaction volumes and grew the point of sale devices deployed in the market by 35% year on year. The growth in headcount was contained at 3%. Branch and ATM growth was limited to 5% and 6% respectively as the focus shifts to digital solutions and channels. New physical distribution outlets are targeted to high growth markets or used to respond to regulatory requirements, as is the case in Mozambique. Our performance has been enabled by our focus on delivering market-leading client experiences. As we become more client-focused, more digital, and more competitive, we delivered the following solutions. In Zimbabwe, we launched a first in the market, the Nedbank bundle account for the middle market. Since rebranding to Nedbank Zimbabwe, we have had good growth in client numbers and usage. Clients are choosing to move to banks perceived to be more stable and with strong shareholder support. We also continued the aggressive rollout of point-of-sale devices in Zimbabwe, where cash shortages persisted. In 2018, we rolled out an additional 1,176 point-of-sale devices, which enabled us to grow total point-of-sale device turnover to 4 billion rand. In Lesotho, we reduced turnaround times for personal loans by 2/3 without compromising the rigorous quality of credit assessments. In Namibia, Malawi, Lesotho, and Eswatini, we added various enhancements to the current mobile app suite to help clients manage their money more conveniently. ETI has delivered 7 consecutive quarters of profitability, and I will leave it to them to announce the next set of results shortly, underpinning the recovery momentum in the business. Although residual risks still persist with the asset quality of the portfolio, the focus on fixing the business has been value-creating to date. Reporting a quarter in arrears, from quarter 4 of 2017 to quarter 3 of 2018, ETI recorded a turnaround of 1.3 billion rand on associate income, resulting in headline earnings of 375 million rand. ETI performance has been driven by strong growth in client deposits, up 10% to $15.5 billion as at end of quarter 3, 2018. Lower impairments and selective origination of new assets resulting in a drop in the credit loss ratio from 320 basis points to 280 basis points. Growth in transactional revenues driven by cash management gains and the acquisition of digital clients, with 7.1 million clients having been onboarded on the EcoBank mobile app. ETI moved, for reporting purposes, from the official rate of the Central Bank of Nigeria of 306 naira to the US dollar, to the Nigerian Autonomous Foreign Exchange Rate, otherwise known as NAFEX rate, of 346 naira to the US dollar from the 1st of December 2018, and injected 64 million US dollars of capital to mitigate FX depreciation effects and to meet regulatory requirements. The EcoBank Nedbank Alliance relationship is gaining traction, and we are improving the way we work together. Over 105 Nedbank wholesale clients have opened more than 215 transactional accounts with EcoBank. In addition to growing treasury and trading activities, Nedbank and EcoBank are beginning to do joint transactions and concluded 2 lending deals: the underwriting of $115 million US debt facility to Anglo Gold Ashanti's Gator Gold Mine, and the provision of a $10 million agriculture commodity finance facility to African Jennings Limited. These deals also included the acquiring of a main transactional banking account as well as working capital facilities. In November 2018, we launched the Integrated Cross-Border Transfer Solution. It is a disruptive and innovative offering. It is the only account-to-account solution in South Africa that facilitates low-value payments to 33 countries in Africa. It is easy to use and available on the Nedbank Money app and Nedbank Secure website. Now turning to prospects. Africa remains vulnerable to volatility risk arising from global developments, general election outcomes, or fiscal and macroeconomic policy constraints. Yet, the economic recovery is set to continue. In its economic outlook for 2019, the World Bank has forecast that economic growth in sub-Saharan Africa will increase by 3.4% this year, improving from 2.7% in 2018. Looking ahead, Nedbank is committed to long-term and profitable growth on the continent. Our ambition is to provide our clients with access to the best financial services network in Africa. In our SADC subsidiaries, the focus is to grow earnings and achieve returns above the cost of equity, and to create scale in the business by focusing on client experiences and optimal client solutions to increase share of wallet. Delivering on digital and data analytics initiatives for effective client value management as we accelerate the digitization of the bank. Strengthening the governance and risk control environment, leading to greater integration of the subsidiaries into the group, especially Mozambique. Serious FX strategies in Zimbabwe created currency depreciation between the US dollar and real-time gross settlements, or RTGS dollars. This precipitated elevated currency risks and resulted in shortage of essential supplies. Going forward, our focus is to support the Zimbabwe business as the economy adjusts to the introduction of the new currency. In ETI, our goal is to support the board-driven strategic agenda and help management to execute on key delivery initiatives. Through collaboration, we are leveraging the investment to unlock new business growth opportunities. Our targets for the rest of Africa remain unchanged, namely to provide returns to the group above the cost of equity of 16% and to deliver a cost-to-income ratio below 60%. The returns target, however, will be more challenging to achieve and will require sustained earnings growth and capital optimization. I thank you and hand back to Mike.
Great, thanks very much, Mfundu. So now, having spent most of the presentation looking backwards at 2018, I'm going to conclude looking forwards to 2019 and beyond. Looking at this slide for our latest forecasts of macroeconomic growth and economic data, you can see we expect GDP growth in South Africa to increase slowly off a low base, with that 0.7% number having been updated this morning to 0.8, with slightly higher growth levels expected in sub-Saharan Africa. We expect inflation to remain well within the SARB target ranges, and as a result, interest rates should remain stable, with some small increases currently projected towards the back end of 2019. So in this sort of economic environment, we expect that client activity across a broad front should improve off a low base, with an ongoing uptick expected in wholesale advances, leading to slightly higher levels of asset growth and revenue generation as we move into 2019 and 2020. Given the pressure that consumers are under and the perilous state of government finances, it does follow that any economic acceleration would have to largely be led by corporate South Africa. As I said earlier, the extent of this acceleration will depend on clarity with regard to government policy like expropriation without compensation, progress on state-owned enterprises and Eskom in particular, and the outcome of the general election in May. On the strategy front, investors should be familiar with this slide that I call the spine of our strategy. Our central focus at the top of the slide remains great client experiences and, as a result, growing our client base faster than the market, with a particular focus on our transactional franchises. We aim to enable this through our investments in technology, that's our managed evolution and digital fast lane programs, as well as the changes we're making to our people, practices, culture, and brand. Given its strategic importance, I'm going to spend a little bit more time on the progress we're making in our technology strategy in the next few slides. In the center of this slide, how people and technology come together is through what we call our target operating model, and that's starting to deliver good benefits. We have right now about 1,500 staff in the bank working in what we call new ways of work. That's the agile squads and tribes I spoke to in the beginning. And our target operating model savings to date of 680 million are on track for the targets that we set ourselves in 19 and 20. The benefits of this strategy are becoming apparent with increase in client numbers in all clusters in 2018. The consequence of this strategy is the delivery of our financial targets for 2020. And while we've said throughout this presentation, we are more confident in meeting our ROE target given some of the IFRS changes and the result of the buyback, while we remain committed to our cost-to-income target, it has become harder to achieve. Looking now at progress on our really important technology strategy. On the left-hand side here, in 2010, we started out by mapping what we call a best-of-breed technology strategy, the managed evolution. And we deliberately chose not to follow either a big bang approach or an opportunistic patching approach. And as we evolved our IT systems over time, we projected that in the center, we would move from around about 250 large IT systems in the bank to 60. And you can see to date, we've already rationalized 136 of these. Our research into core banking replacements, and we visited and learned from banks across the world, has convinced us that this managed evolution approach will enable us to achieve a world-class tech platform in a cost-efficient and risk-mitigated manner without a full core banking replacement. The outcomes of our managed evolution process will be evident in faster and cheaper innovation cycles, more end-to-end digitized products and services, improved client experiences, as well as improving efficiencies over time. So this slide is quite busy, but I want to land a couple of key messages. On the left-hand side, we set out for you the key elements of our managed evolution investments to date, split into the 7 major underlying programs, together totaling expenditure to date of some 7.7 billion rand. In the center, we show you on 2 axes the percentage completion, that's on the x-axis of each one of those 7 programs, and the sequencing on the y-axis. And you can see that currently we are approximately 60% complete across this program, and we aim to be materially complete by 2020 and 2021, with perhaps only some core banking refactoring moving into 2021. Then on the right-hand side, we show you, for each one of these 7 programs, what we still require to complete between now and the end of the managed evolution. Off this more digital and agile platform, I'm really excited about the products and services that we plan to launch in 2019 and 2020 that we believe will have a really positive impact on client satisfaction levels. And I'm going to highlight some of those shortly. We get lots of questions on the balance sheet and income statement impacts of the managed evolution journey. So this slide here highlights that on the left-hand side, our annual cash flow expenditure on IT is expected to peak in 2019 at similar levels to 2017 and 2018. As a result of that, in the central graph, the capitalized software asset on our balance sheet is expected to peak in 2020 at just over 9 billion rand. And then on the right-hand side, as a consequence of that software asset, the amortization charge will escalate. On the one hand, as you see on the right-hand side, but across the bottom of the slide, we show you operating model efficiencies, branch optimization, and reductions in core systems and related maintenance costs, such that while we expect depreciation to increase faster than other expenses, we still expect the cost-to-income ratio to reduce over time. Shifting from a financial view of our tech journey to an exciting client view of the outcomes of the managed evolution. Onboarding new customers has historically been a very paper-intensive and painful process, in particular with respect to regulatory compliance and duplicate requests of clients for documents by product. Our new onboarding systems, which are a material part of the managed evolution journey, whereby we aim to onboard clients once with products as a drop-down box, is currently in pilot and in our retail businesses for rollout in the first half of this year, alongside web-based application forms for personal loans and transactional banking. Over time, these web-based application forms will become our new branch platforms in our branches. This is a foundation for the full digitization of our top 10 product sales journeys and 180 services, of which 70 are already digitized, between now and 2020, enabling for our clients a true omni-channel experience across branch, web, app, and call center. We also, in the second half of 2019, plan to deploy a really exciting relaunch of our client-centric customer loyalty and rewards program. So in my final slide, I'm going to turn to our usual format of financial guidance for the year ahead based on our current macro forecasts. Starting with net interest income, we expect average interest earning banking assets to grow at upper single digits in the year ahead as CIB growth picks up and RBB growth maintains its current momentum. On the net interest margin, we expect a slight reduction from the level of 3.65%. As wholesale asset growth increases, that would cause some negative mix change in the margin, and there are also going to be some slight accounting implications from the new introduction of IFRS 16, which happens this year. On the credit loss ratio, we have a high-quality advances book, and we would expect from the low point of 53 basis points a slight increase in our credit losses, but for them to remain within the bottom end of our 60 to 100 basis points range. On non-interest revenue, as was evident in the like-for-like growth rates in 2018, we believe we have good growth momentum that should continue, and we expect non-interest revenue to grow between mid and upper single digits. Finally, on expenses. In 2019, we will benefit from the final credit of post-retirement medical aid, that credit that Rasibi spoke about that didn't happen in the second half of 2018, as well as ongoing efficiencies. But we expect these to be offset by some new costs like the Youth Employment Service and our exciting investments into building platforms. As a result, we expect expenses to grow slightly above mid-single digit growth, but below revenue growth. And as a result, we plan once again to deliver positive jaws in 2019. So putting all of this together, we expect that currently diluted headline earnings per share in the year ahead will grow at greater than or equal to nominal GDP growth, which we expect to be somewhere around about 6%. So thanks very much for listening to that rather long presentation with a particular focus on our technology journey.